Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Alphabet, Microsoft and Meta all out with results showing heavy spending on AI and data center construction.
Plus, Roblox CEO Dave Baszucki joins us to discuss the company's earnings as users are jumping, but so are costs.
And we'll break down what was said during the meeting between President Trump and China's Xi Jinping. What wasn't discussed? NVIDIA's Blackwell chips.
Let's turn our attention to these markets, though, and after record high, we take a breather. The Nasdaq 100 under pressure, off by almost a percentage point. This as we think about the Fed maybe not baking in that December cut as much as the market had anticipated. You add to that some concerns about AI spending. You add to that a China-US trade détente for a year that many felt were priced in, Ed, and we just come down some across all asset classes. But you're looking under what's in the equity moves.
Yep, let's get through the top stories. NVIDIA is down 2%. Blackwell, its latest processor, was not discussed in the meeting between President Trump and Xi Jinping. Later in the show, out to South Korea to get the details of that meeting. Then there's earnings. Microsoft, 39% top-line growth in Azure, the cloud computing unit, the only unit that mattered, but the stock selling off, high bar for investors. Alphabet is the one that's higher. It told us what its capital expenditures are this year, but it also told us about growth, a real number on AI or generative AI-related products. Then Meta, it is the biggest decliner and the biggest drag. Capital expenditure concern, then this morning coming to market with an up to 6-part bond sale. Maturities ranging 5 to 40 years. The 40-year note, 1.4% over treasuries, above treasuries. There's a lot to discuss in Meta's capital requirements and then what it has to show for it. Let's do that with Brent Thill, Jefferies analyst, joins us right now. Let's start with Meta. That's kind of the equation, right? Okay, capital expenditures will be higher next year than they were this year. Then what? Give us more. Give us some longer-term outlook. There just wasn't a formal guidance. Is that what spooked the market?
Yeah, Meta was just in a period of being really comfortable. Zuck had been very comfortable. The company had executed. They had invested, and they were harvesting those investments. And now they're going back into invest mode. So I think at the beginning of the year, advertisers were saying that Meta was more sheltered because they didn't know what Google was going to do with AI, and we didn't know what was going to happen to TikTok. And then halfway through the year, everyone realized, hey, Google's got their act together in AI, and we know that TikTok now has more of a foundation. So I think, as I call it, there's less of a tailwind for Meta. It's not a headwind, but it's less of a tailwind than they had at the beginning of the year when you talk to advertisers. And I think what Zuck said last night on the call was the investments in AI are paying off, and they just need more of them. Because everything they built, they felt like they had overbuilt and they sold out of what they built.
Yeah.
So they have to build more. And so, yeah, it doesn't have anything to do with the fundamental position. It's, are we going to see margin compression, and then when does that return come back? But we already know that they have a return. We saw with Microsoft, they've given us margin expansion, even in the face of AI. So this whole concept that AI doesn't pay off is silly.
Yeah,
We've already seen
but the stock move is so big that we question, yes, we see Zuck on the call saying, look, I'm worried about underinvesting. We hear once again from Susan Lee that they're going to make notable investments. Everyone knew CapEx is going to go up and to the right. Why is there such an air pocket on this stage, you think?
Well, I think the outperformance of Google, I think you have money chasing. We're in a momentum market. I mean, look at yesterday before any earnings. Everything in applications went down, anything in AI went straight up, in infrastructure. So if you have CapEx going this high, the pushback is, why do I invest in internet and software right now? I should be invested in energy, in land, in all the enabling infrastructure. I mean, infrastructure goes up every day. Look at all the energy names. They're all ripping. And so I think there's a common pattern with tech investors right now. They're just, broader investors are moving their investments to other categories, and then they're chasing momentum. It's just, the market's so narrow, and you're seeing this. So there was nothing that was fundamentally offline. They're making the investment. They've done this before. How many times have we seen Meta do this? And then in return, the stock goes higher. They're going to do $30 of earnings power. Put a 30 multiple on it, you're $900 on the stock. It's a buy on the pullback.
Brent, the name with momentum is Alphabet and Google, right? They gave us 2 data points. Capital expenditures, $91 billion to $93 billion. But revenue from products that are built on Google's generative AI models grew more than 200% from a year earlier. That second part, your reaction to it?
I mean, AI is working. And I think the fear that investors have had is what happens when I go from a world of search to AI? And I think Google is showing they can do the high wire act very well between search to AI. Everyone thought search would implode. In the last 2 quarters, they beat the search number. This quarter, they accelerated their search number. So what they're saying is that search can be anywhere. It can be inside AI. It could be in their own search engine. It could be at YouTube. It could be across different properties. And I think what Google is demonstrating, and we've said this kind of for a while, they have better AI underneath the hood than they're articulating, and it's now coming out. You can see it. We said, they kind of pulled up to the AI race, in a Toyota Camry body, but they have the biggest engine, and they pop the hood, and everyone's like, whoa, this is incredible. And so I think everyone is realizing, when you look at Gemini, I mean, we ran bench tests. It's almost equivalent to ChatGPT. And then you look at the breadth of their offering. And again, remember, they own the world's internet data. So you need data, users, and capital for AI to work. And they have all of those, almost better than Meta, Microsoft, many of the others. They have more data on anything in the world than anyone. So right. I think they're proving that this engine's working. The body didn't look great. They're upgrading the body, but the engine is really, really good.
But what's so interesting is clearly Microsoft is still working. When you're looking at Azure growth of 39%, that was better than the market had anticipated. Sure, it might not be much of a growth uplift, but what was it? What was the fly in the ointment for Microsoft, where Amy Hood again is saying my issue is supply, not demand?
I don't understand the market because they just put up over 50% RPO or backlog growth and 110, 111% commercial bookings. Those numbers are insane, and that didn't even include OpenAI's $250 billion incremental dollars. So I think the market's got this wrong, honestly, that you got to look at the backlog. The backlog is the leading indicator of health. The reported Azure number does not matter. When you're putting those backlog numbers up, that tells you they're capacity constrained. You can't book that kind of revenue and not take it to Azure. And the differential is they just can't get the capacity up right now. But their customers want to spend, and their customers are spending, and they know that what Microsoft has. So I think this is a common pattern where you're seeing massive backlog growth, commitments to AI from their customers, but Microsoft can't literally physically provision it fast enough. And when we talk to Microsoft offline, like the Azure number would be way higher if we didn't have the capacity constraints. So this is not a demand issue. Yeah. This isn't a competitive issue. This is an issue that the industry is facing right now across the board, is they can't get enough of it to their customers. That number would have been way higher because you can't describe the math of the backlog being so high and Azure where it's at. So I think, again, we look at it, it's important. Wall Street cares. I think Wall Street should care more about backlog and bookings. This is, again, what all Oracle trades on. Yes. They don't care about revenue. Why does everyone just care about revenue now? So I think, again, the Street's got it wrong.
Street's got it wrong. Brent Thill of Jefferies putting it right. We thank you so much. Coming up, more about earnings. Roblox CEO Dave Baszucki joining us to discuss the company's numbers. Daily active users for the gaming platform topping 151 million, Ed.
Let's look at CoreWeave. Shares down more than 6%. Core Scientific investors have voted no on CoreWeave acquiring the company. You'll remember that CoreWeave tried to buy Core Scientific in July for $9 billion, and the advisory firm said that undervalued it. BI reacting, saying it actually won't impact operations of CoreWeave. But another headline on the terminal, as soon as that vote was decided, CoreWeave to buy Marimo, terms not disclosed. Maybe a sense that it's moving on very quickly. We'll have more when we can. This is Bloomberg Tech.
Grow a garden, 99 nights in the forest, still a brain rot. 3 games propelling Roblox to its highest level of daily active users. The company also posting nearly $2 billion in bookings in the third quarter. Still, shares of the company trading lower after the earnings. Let's talk through all of this with Dave Baszucki, founder, CEO of Roblox. And Dave, this growth, this real playing commitment comes at a cost, an infrastructure cost. And we see costs go up because of safety that you're enacting, but also the cloud compute. How do you start to monetize to make up for some of those costs?
Yeah, thanks for noting the amazing quarter we just had. Both bookings growth was up 70% year on year at 1.9 billion. And as you noted, our daily active users passed 150 million, which is up 70% year on year. In addition to those 3 games you mentioned, we had 7 games on Roblox in the last quarter past 10 million daily active users. And a really healthy content ecosystem. 5 of those 7 experiences were created in the last year. We've hit some really peak numbers. We had 45 million concurrent players all at the same time. Right. What we said on the earnings call is with all of this growth, which is cumulatively averaging 37% over the last 2 years, we are going to be spending on infra. What we said is the continued decreases in cost for infra, we may slow that down a bit as we spend. But the final thing I want to generate is the cash flow that we generated on the platform. We generated over 440 million of free cash flow in Q4.
Dave, looking forward then, how are you managing out some of the technology plays that you made, age verification technology, in a way that doesn't impact or slow the growth of both active users and the bookings?
We've made a commitment a while back to what we believe will be the gold standard for safety on platforms like Roblox and throughout the industry. With new advances in AI, we're going to use facial age estimation to estimate the age of everyone on our platform. And in addition to the text filtering we do, the critical harms monitoring, the prevention of any image sharing, we're going to use that to help gate who communicates and who they communicate with. I was just in an executive staff meeting on Tuesday playing with the rollout of this product. It's really elegant. And we, of course, want to highlight there may be some friction, but I'm really optimistic. This is the long-term good play for Roblox, which is really establishing the standard of how we believe safety and civility is going to run in the future.
And that, your CFO made the point, that's going to have long-term value for shareholders. You make it again, Dave. Talk to us, therefore, about the new technology, not just in safety, but also in how you build games and high-fidelity feeling of a game. But some of these big winners that we've had, and we listed them at the top, they are kind of more old-school feeling in many ways, but they're the ones breaking records. Grow a Garden, more classic and blocky. How do you compromise on that?
We've highlighted our vision of getting to 10% of all the global gaming content market running on Roblox. In this quarter, we passed 3%, so there's a lot of room to go. We have an enormous amount of new technology coming to support more diverse experiences, to support different types of avatars, to support competitive gaming in genres like racing or sports, to support role-playing games and other types. And we really do have a vision for genre expansion, but in a really future-looking way, in that when creators make experiences on Roblox, they run well either on low-end Android devices, like a 2 gigabyte Android phone, or on high-end gaming PCs, and they run around the world. So we're optimistic with the new technology, our economics and discovery. We're going to see a diversification of the types of experiences we see on our platform.
Dave, you want 10% of the gaming content market. That changed in the quarter. I saw layoffs at Amazon and Microsoft's gaming divisions. Electronic Arts elected to go private. The big publicly traded peer that you have, private with the Saudis. React with your interpretation of what that signals for the market you're trying to grow in.
Well, people estimate the global gaming market somewhere between 180 and 200 billion. What we've seen on Roblox is really a future-forward optimistic look at gaming. We've seen new types of genres, given the Roblox platform, the ability to play with friends on different devices. Dress to Impress last year was a whole new type of experience. People competing in a fashion show. Grow a Garden, I'm really proud of, because hitting those top numbers, making new records for over 20 million concurrents, is literally a game you can play either while you're there or when you're not there. Your garden keeps growing when you're not playing. So I think the way to think about this is not just protecting against the history of gaming, but looking at whole new types of games that are going to be built on platforms like Roblox and accelerated with AI as every game starts to have access to AI as well.
Dave Baszucki, Roblox CEO, thank you very much. Let's stick with earnings in tech. Comcast was also out before the bell this morning, with the company managing to slow the tide of broadband and cable TV customer defections in the third quarter with help from an internet price lock guarantee and some bundle plans. Let's get out to Bloomberg's entertainment reporter Kelsey Griffiths in D.C. Give us the need to know on Comcast.
This is Comcast's 10th straight quarter of broadband losses. So the company came into this quarter knowing that they had to do something to start stemming this tide, like you just said. They did, in fact, succeed in kind of slowing some of those losses. Even though those numbers weren't positive necessarily, they were losing customers at a slower rate than usual. And so the executives were saying that some of the changes they've made over this year earlier seem to be working.
Seem to be working, but the share price is still lower. And what's interesting, maybe in some of the analyst notes, there is a concern that maybe they'll spend more, particularly when they're thinking of making a bid for parts of Warner Brothers. What do you make of that, Kelsey?
That's right. Warner Brothers is one piece of the strategy that Comcast said they're looking at, although they didn't express a really high level of interest. They said, when something like this in our industry comes on the market, it is something that we have to take a look at. But look, we're good with our content strategy, even without M&A. They just succeeded in luring Taylor Sheridan over from Paramount Plus, and he is going to be a really big part of that content landscape going forward for them. They also have NBA TV rights, and those are things that they're really excited about in the nearer term.
Great roundup. Kelsey Griffiths, we appreciate you on Comcast. And let's just stick with the Warner Brothers story a little bit more, because CEO David Zaslav said that the board would need a higher bid to justify a sale of the company. He said those comments during a town hall meeting for employees yesterday, according to sources. Now, Zaslav also told the staff that the board had rejected 3 offers from Paramount, Skydance said.
OK, coming up, President Trump and China's Xi Jinping attempt to ease trade tensions inside their high-stakes talks on the future of the global supply chain. We have all the details next. This is Bloomberg Tech.
Discuss chips, and they're going to be talking to NVIDIA and others about taking chips. We're not talking about the Blackwell. That just came out yesterday. But a lot of chips, a lot of the chips, and that's good for us.
That was President Trump speaking to reporters on board Air Force One after meeting with Chinese President Xi Jinping, saying chips were in discussion, but NVIDIA's latest Blackwell was left off the table. Bloomberg's Tyler Kendall has been traveling with the president and joins us from South Korea. What is the absolute latest? What do we need to know about that came out of those talks between Trump and Xi Jinping?
Yeah, hey, Ed. Well, when it comes to NVIDIA chips, it certainly dampens any speculation that Washington would go on to approve the sale of such chips to China. President Trump went on in that gaggle on Air Force One to be asked specifically whether or not anything was brought up about the potential for a downgraded version of the Blackwell processor. He said that it was not, but that ultimately NVIDIA, the company itself, is going to continue direct talks with Washington. As you well know, NVIDIA has been trying to regain market access in China since 2022 after going from a 95% market share peak down to zero. But I have to say this was welcome news in Washington this morning for those defense hawks who have previously advocated against such sales over national security concerns, which brings us to the broader issue of the general trade talks, because while we are getting this easing in tensions, our own analysts at Bloomberg Economics say those more fundamental issues, including national security, were not ultimately addressed. But Ed and Caroline, of course, welcome news that we are seeing what appears to be at least a year extension when it comes to the broader trade truce.
Bloomberg's Tyler Kendall, thank you so much. That's the latest from South Korea. Let's get more news. Caro.
Yeah, it's time now, Ed, for Talking Tech. And first up, OpenAI is said to be preparing to file for an IPO as soon as next year that could value the company at $1 trillion. But it's all according to a report from Reuters. The company is said to be considering filing the paperwork with regulators soon in the second half of 2026. Plus, Microsoft says its cloud services are recovering from an outage that disrupted workplace software products and impacted several companies. But the outage prevented people from checking into Alaska airline flights, for example, and disrupted features in Microsoft's own Copilot AI. Meanwhile, ex-consultants from McKinsey, from Bain, from BCG are recently contracted to train AI models on entry-level consulting work for OpenAI. Now, Bloomberg has learned that Argentum project is run by the same third-party firm using ex-bankers to train OpenAI on financial models. Ed.
Okay, coming up, we have more Magnificent Seven earnings coming up after the bell today with Apple and Amazon, and we're going to have what to expect from those giants next. Apple up, treading water 0.3%, Amazon down 0.9%. Maybe there's more read-through there from the other cloud names and what that might or might not spell for Amazon, or at least investors' attitude towards it. Elsewhere, we know what the story is and the top stories of the day. Stocks moving in different directions on the earnings context. Meta's down 12%. Really interesting. Notably higher capex in 2026 and 2025. Alphabet gave us the same number of capex, but they also told us how revenues directly tied to AI are growing. And right now, the market's rewarding that with the Google parent up 5%. This is Bloomberg Tech. Welcome back to Bloomberg Tech. Let's recap the three magnificent names that already reported last night. Different stories. Microsoft down 3%. Azure growth was 39%, above consensus, but it was a high bar quarter. Same story across all three of them as we know the capital expenditures environment. Meta told us that capital expenditures would be notably larger next year than they were this year, but the investor base is spooked a little bit because we don't have this kind of longer term outlook for how that translates to sales. Apart from we do from Alphabet, the parent of Google. So they told us what the capital expenditures picture looks like, but also that their products that result from investment in data center capacity, AI models, generative AI, grew 200% year on year. And that name is up 5% in direct reaction. And there are so many more earnings out there, Cara.
There are. And another one on the rise is ServiceNow, Ed. It gave an outlook for strong revenue growth, said AI, of course, is helping the company reduce its own costs. We spoke with ServiceNow CEO Bill McDermott a little while ago.
The most important thing is to reinvent all of these back office operations in companies. So, for example, in our company, whether it's IT support or customer support or security and risk, 90% of this work now is being done by agents, but not at the expense of people. The people in our company now have an AI teammate on their shoulder to do the things that they'd really never really liked very much.
Earnings season continues with both Amazon and Apple reporting later today. Let's talk about what to expect. Bloomberg's equities reporter Ryan Vlastelica. Let's start with Amazon then. It's down a percentage point. Maybe there's some read-through from like what we learned about cloud computing from the three that went last night. What are we expecting?
Yeah, absolutely. I'd say there's absolutely people looking at the results we saw last night from Microsoft and Alphabet and kind of extrapolating into what we could expect from Amazon. I will say that there has been some growing concern about the strength of AWS, that's Amazon Web Services, the cloud computing business there. Some concern that it is falling behind, maybe losing some market share, not as quite well positioned for the AI era. And maybe the fact that we saw such strong results, especially out of Alphabet, maybe indicates that maybe it's going to be on the back foot a little bit here. There also continues to be a lot of focus on how much these companies are spending. Amazon, of course, has very high CapEx levels, not only with building out its data center and cloud business, but all of its logistics operations. I'll be very curious to see there if we get any sort of improvement on the margin front, especially when it comes to commerce. I'd say that those are the two major things people are looking at there.
AI use deployment all about for Amazon, almost for Apple, it's ignored. We're just wondering how iPhone 17 and Air are doing.
Yeah, absolutely. So far it seems like the iPhone 17 is selling pretty well, especially the higher end model. So that is a tailwind, especially when it looks at average selling prices right there. People I've spoke to have said that maybe a lot of people who bought phones during the start of COVID and the pandemic 5 years ago, maybe they're just at a point right now where they're starting to upgrade even without AI features, even without the foldable phone that's expected next year. So there is a lot of optimism that the strong iPhone sales that we've been seeing indications of so far, maybe there's room for this to grow over the coming quarters, especially as we get new designs, more AI features and so forth. Of course, now the question is, you have a stock that's valued at $4 trillion, it's in hitting record levels. Is all this optimism going to be justified by the results that come out this afternoon?
Yeah, meanwhile, Amazon languishes at only about $2.5 trillion. Bloomberg, Ryan Vlastelica, thank you very much. Now let's just talk about where investors' heads are at, how they're reacting to this really busy week of earnings. Ipek Oskardeshkaya is with us, senior markets analyst over at Swissquote. We had Brent Thill from Jefferies on the top of the show, and he said he doesn't understand the market right now. Do you understand the market if you're looking at Meta being sold off so hard, Alphabet rising after earnings? Oh, I think you're on mute, Ipek. Oh, we'll get back to her in a minute. Technology on technology shows. And this many years into Zoom, sometimes we don't press the right button, Ed. But really, I do think the bond sell coming from Meta is a key one to be discussing, because we have got this bifurcated market where we're selling off certain names in particular when we're worried about capital expenditure. But what more was Meta to do? 26% growth in terms of revenue, record numbers. We're also thinking about what, therefore, that pushes forward to Amazon and how much they have to vindicate the spend on capital expenditure, too.
Yeah, one thing I'd say as we go back to Ipek Deshkaya, who I think is now good and back with us, is with respect, do investors have short memories? Because Meta told us in the prior quarter that capital expenditures would be higher in the next fiscal year. They used a different language this time around, which was notably larger in fiscal 26 and 25. But maybe it's what they didn't say. They didn't tell us what top line or bottom line growth directly from AI investments looks like. What's your read?
Well, actually, for Meta, the investments look more riskier than they are for Microsoft or Amazon, who do have these data centers. And they say that if we overinvest, we will have the option to sell this excess capacity. And if you're looking at the market reaction and the mixed reaction there, we also think that the macroeconomic context here is very important. Important in the sense that just before these earnings came out yesterday, the Federal Reserve said that they're not sure that they will be cutting the interest rates by 25 basis points. So I think that also dampened the mood just before the earnings came in. Looking at the spending, these companies must spend in order to keep up with demand. And Microsoft has been very clear about the fact that they have not been able to catch up with the significantly higher demand. So they must invest. They do have the free cash to invest. And if they do not invest and miss the turn, the AI turn, that would be worse for investors than seeing them over-investing. So I think that in the context of the actual growth, these companies must invest, and it doesn't really bother us as long as there are no concerns about oversupply, and this is not the case right now.
Look, Meta said if they have too much compute, they can start selling it to others. So is this an air pocket? Is this just where people buy into weakness? Or is there going to be a significant pullback and questioning of the market writ large if the Fed isn't going to be cutting come December?
Well, I think that the Fed situation could eventually lead to a certain pullback in valuations. But I don't think that that's going to be a bubble pop kind of a market reaction, because these companies must invest now in order to make sure that they don't hit into capacity constraints 1 year, 1.5 years from now. I believe that investors understand that. There is a report showing that, or claiming that the data capacity computing needs will be doubling every 9 to 18 months due to our AI application. So these companies must keep up with that pace. And again, I believe that these spending plans have been almost entirely, put out there. So they have been revised higher, but this is not a surprise coming in right now. Looking at the deals and the strength of the demand that we see in the sector, these companies are out there trying to keep up with the demand. And I believe that, again, as the executives are also saying, not keeping up with the demand or risking to head into capacity constraints is worse than over-investing right now.
What's interesting is, of course, perhaps just to show the amount of spend that was necessary, Meta comes to market with a ginormous $25 billion bond sale. And talk to us about demand across assets for AI-related companies. Sure, we pull back in equities that are near record highs. How is demand looking for the bond side of the equation?
Well, I think the bond side is also looking well, especially right now. We have seen that the bond sales have been quite interesting for these companies. I believe that in the actual environment as well, the bond sales are going to be interesting. Some investors who are not necessarily willing to take the equity risk at the higher valuations, they will be flocking into the bond side of the market. You are not expecting them to move separately. You expect them to move in tandem. But on the bond side, the potential of rise is less, and the risk that you are taking for it is also less. So this is another way of taking exposure, positive exposure to these companies without, however, taking the risk of the equity fluctuations.
Ipek, if I take the earnings statements and call transcripts of all the tech earnings we have so far, run them through ChatGPT and ask ChatGPT to cross-reference for a theme that is not capital expenditures, what would I get? What else do you see that they have common between them?
Well, the capital expenditures are actually rising. I don't know. I haven't asked ChatGPT what he thinks about it. But what we see is that this is growing exponentially, and there is investment worries about that. But if you do not invest today, again, a year and a half from now, you might hurt into bigger capacity constraints. What's happening right now is, if today, for Microsoft, for example, you are not able to catch up with the demand, then tomorrow it's going to be harder, because it will just go divergingly, because the demand is going to be exponentially rising, and that's the main issue. That's why these companies are investing so badly or so highly. And this is, I think, what ChatGPT will tell you, because as the AI applications will be up and running, demand for computing is going to rise exponentially. And this is exactly why NVIDIA is also not only concentrating today on the AI applications, but all on the networks and intelligent networks as well, to make sure that even the networks and the pipelines will be able to handle all that data flow down the road.
We did get a Fed cut quarter point for a second consecutive meeting, and we did get a warning that a December rate cut is not a foregone conclusion. Ipek Oskar-Deshkaya, senior markets analyst at Swissquote, having the earnings and Fed story both. OK, let's head over to the Economic Club of Washington, where Goldman Sachs CEO David Solomon is speaking with David Rubenstein, Carlyle co-founder and host of Peer to Peer on Bloomberg Television.
Business education for small businesses, given the importance that small businesses play in our economy here in the United States, the entrepreneurial spirit, I think 35% of the private workforce in the United States is small businesses, that if we could make an investment in that community and use our expertise, our knowledge, and transmit it into that community, it would spur more investment, more economic growth. And so over the course of the last 15 years, we've had 17,000 businesses go through this program. And a few years ago, we created a platform called 10,000 Businesses Voices to bring graduates of that program to DC periodically, to go up on the Hill and spend time with members and senators on policy issues. And so we have 2,000 small businesses here, a whole program for a few days, over 300 meetings with policymakers down here in Washington to really engage and talk about things that matter to small businesses. And when you think about the power of the U.S. economy, you can't understate how important this entrepreneurial spirit. It's different from other places in the world. It's really great for our country, and we've been really, really excited about the differences that this program has made. These businesses that graduate hire at 4 times the pace of small businesses that don't graduate, and they employ over 325,000 people. It's about $30 billion of revenue. It's an incredible cadre of businesses.
So let's talk about some government matters now you're in Washington. The Federal Reserve, you've talked about the importance of the Fed being independent. So are you worried about the independence of the Fed? And the Secretary of Treasury has announced 5 potential next chairs of the Fed. Are any of them or all of them acceptable to you?
Well, let's get right into it, David. First of all, I just say, and I think it's a point that's worth emphasizing, central bank independence, not just here in the United States, but around the world, I think it's served us very, very well. And I think it's something that we should speak out for, we should strive for, and I think it's important. I'm not going to comment on the individuals other than to say I think all 5 individuals, carry skills and experience that could make them credible candidates to be a Fed chair. I think we all know that there's one person that's going to make that decision as to who the next Fed chair is.
Really? Who do you think that would make that decision?
David Rubenstein.
So let me ask you, some of your predecessors have served as Secretary of the Treasury, Bob Rubin, example. Any interest in your part on going to government service ever, being Secretary of Treasury or something like that?
Well, at the moment, I'm super interested and super excited about Goldman Sachs. So at the moment, I'm working away and very focused on that. But I've been incredibly privileged in my life, and what I've had, the experience I've had, what I've been able to do. And later at a different stage, I'd certainly be interested in finding ways that I could give back and serve, and that would certainly be an interesting path.
All right, what business people like is certainty, generally. They like other things too, but they like certainty. And sometimes the government of the United States is oscillating its policies a bit, like on tariffs, other things. Has that made it difficult to do well on Wall Street for Wall Street firms, or Wall Street firms seem to be doing okay, but has the changing in policy, what the tariff we're having here or not having it, or other kinds of things, has it been difficult for Wall Street firms to deal with what the administration is doing, or is it actually not a big problem?
Well, first of all, I'd say not just business people. I think people like certainty and predictability, and I think people hate change. I think generally speaking, it's human nature. We hate change, but change is super important. It's inevitable. In fact, I have on my desk in my office, I have a little plaque that says on it, "Change or die." And I do think, as a business leader, one of the interesting perspectives you have to have is you've got to constantly evolve and change. I think government policymakers, there's always uncertainty, there's always unpredictability in all different kinds of administrations. Okay. And I think our job as business leaders is to adapt and to adjust and deal with it candidly. I think that's what I think we do.
All right. So the debt of the United States is now $38 trillion. Some people would say that's a lot. And you would think that, people in Washington often say, well, there was a problem. The people in New York, they wouldn't be buying Treasury securities if it was such a big problem, because it wouldn't be a good investment. And then the people in New York say, well, the people in Washington must know what they're doing. If they're borrowing this money, they must know how to figure out how to pay it. So what is the story? Why is the business community not worried about, as a general rule, they don't seem to be as worried about the $38 trillion as I would have thought they would be?
Well, I speak to a lot of people in the business community, a lot of people in the financial community, and I think people are worried about the level of debt and the fact that we've reached a point, and by the way, this is true in the United States, but it's true in every developed economy, where kind of fiscal stimulus and an aggressive fiscal play is really just kind of embedded in the way these democratic economies are operating. And it's accelerated meaningfully in the last 5 years. I think the pandemic, played an accelerating role, and it doesn't seem like we have an ability to pull it back. And so we've taken the debt, in the last 15 plus years, kind of since the financial crisis, from 7 trillion to 38 trillion. And just refinancing it for the rest of the decade, what's got to be refinanced, if you look at current rates, is going to grow it into the low 40s, for sure. And we're growing our spending at a reasonable rate still. And so this is an issue we have to wrestle with. Now, the path out really isn't a revenue path out. The path out is a growth path. And, if you think about it, the difference, trend growth is 2%. the difference between compounding growth of 3% and 2% is monstrous in terms of dealing with this issue. So there's a lot of discussion about running, a real growth play. I think we have some things that are going on that give us a better opportunity to have a higher growth trajectory, particularly, technology, AI, getting embedded in the enterprise, the productivity opportunity from that. But if we continue on the current course and we don't take the growth level up, there will be a reckoning in this. And the bottom line is we have to find people, to buy and finance our debt. And, ultimately, it's not going to be other people around the world. If it keeps growing, it's going to turn to us. And so that crowds out investment, that ultimately slows growth, and it can become a problem. It doesn't have to be a crisis, although you can have a speed bump. And if you want to see in places where you don't have the advantage of the dollar, go look at gilts in the UK and look at the volatility in gilts where they're having budget problems. But there are budget problems in all these economies, and we should be concerned about this. I'm not sounding an alarm bell, but I do think over time, this is an issue if we continue on this trajectory.
Is Wall Street worried about the fact that government is shut down? I mean, this is a fairly long shutdown, or people on Wall Street say, well, it'll get started again at some point, or have you seen the adverse impact on your business as a result of the government shutdown?
Well, I think we all should be concerned about the fact that the government shut down, and I think it's unfortunate that we have government shutdowns, and this one's now going on for a period of time. As it goes on longer, it starts to have an economic impact, and it starts to filter through the economy, and we're getting to that point in this.
Who do you think is responsible for the shutdown?
The government.
Right. Well, let me ask you. I know you're not going to answer that question. So, every 7 years, on average, the U.S. economy's had a recession. 7 years on average. We haven't had a recession for quite a while. Are you worried about any potential recession coming, or you think the economy is in pretty good shape?
Well, I think the economy is in pretty good shape at the moment, and I think when you look at kind of the give-gets, in terms of tailwinds and headwinds, there are more tailwinds at the moment. I mean, I go back, we're still running a pretty aggressive fiscal play. The AI infrastructure investment boom, you've got 6 or 7 large companies that are going to spend $350 billion, this year on AI infrastructure. That has an effect on growth. We also, after a period of kind of heavier regulatory oversight of business broadly, there's now a pretty clear, by this administration, a pretty clear systematic look at regulation and more of a view toward what regulation is really necessary and works as effective. And that's a tailwind for growth. And so you also have, as AI gets embedded into the enterprise, you have real productivity gains. So we've got a big, diverse economy. It's in pretty good shape at the moment. There are things we can't see that could set it off, but I think the chance of a recession in the near term is low. But that's one of the things about sentiment shifts and changes and surprises. You generally don't see them until they're right in front of you. And I certainly think we're late cycle.
On AI, some people would say that there's maybe a little bit of a bubble in AI. Other people would say, well, it's really it's going to change the world. It's a really great add to productivity and so forth. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just it's hard to call it because the technology trend and the investment is real. Right. It's real, and there's real productivity that's coming out of it.
Alan Greenspan also said around that time that because we were balancing the budget in that year, that soon we'd be paying down so much debt there wouldn't be any indicator against which you could measure corporate debt because there wouldn't be no federal debt. That's not a problem now, I guess, right?
I think we have a slightly different lens.
So on the dollar is down about 11% or so against the euro and some other currencies as well.
This year.
Yeah, this year.
I mean, in the last 15 years, it's up monstrously.
Right. But did you worry that it's gone down, or you think it was overvalued? And as a result of it having gone down, you think the chance of a Plaza Accord orchestrated effort to take it down even further is unlikely, and you think the dollar decline now is okay, it's adjusted appropriately?
I think you have to start, David, with a point of view that the dollar and the relationship between currencies fluctuate. And, the dollar's been on a pretty good run over a long period of time, and it's certainly given back this year, given some of the policy actions, some of the gains. But fundamentally, the dollar is the reserve currency of the world. I don't see anything at the moment that threatens that. And even when we were talking about, debt and, our fiscal debt, when you get around the world and you look at all the capital flows around the world, global allocators, 50% of their capital is coming into the U.S. They might be hedging the dollar a little bit differently now than they might have been for the last few years, but I think it's more at the margin. So I think it's something to watch, but I'm not concerned that there's some fundamental shift. And actually, when you think about digitization and tokenization and access to the dollar, over time, it's actually allowing easier access to the dollar around the world, which in the long run is a benefit for the dollar and the dollar's position in the world.
The financial community, by and large, would you say they're reasonably happy with what the federal government's doing these days? They're not jumping up and down? Or when you come to Washington, are you asking the Congress to do anything in particular, or you guys are pretty happy with where things are?
Well, from a macro level, there are gives and gets. I mean, there are things that you like and things that you don't. On a micro level with Goldman Sachs, we always have things. Every business, every enterprise always has things that they come to Washington to ask about. Everybody's got their agenda. But this is a pretty, for our business at the moment, this is a pretty constructive environment. And I think, the business community felt that the last 4 years was less constructive if you were running a big business enterprise. And so one of the things I think that we really value is we didn't feel like we could go and engage and debate and listen to. And this administration is certainly open to hearing from us. That doesn't mean that they agree with everything we say or that we agree with everything they say, but the engagement is available and very constructive, and I think that's a real positive and a good thing for the system.
What about crypto? Is crypto now important for Wall Street? It's an important business, and are you a big believer in the viability and the good investment opportunities related to crypto?
Well, crypto is a big word because it means all different things to all different people, from cryptocurrencies to blockchain to stable coins and digitization and tokenization. I'm a big believer in the technology of the blockchain and the ability for us to change the financial infrastructure, the rails, to increase speed and decrease friction. And that's a very, very good thing for the system. That's different than a debate on the long-term value of Bitcoin. I think Bitcoin looks like a store of value. I don't have a real long-term view, on that, a strong long-term view, but I do have a very strong view about tokenization, digitization, stable coins, and innovation around the whole financial infrastructure. It's coming at a very quick pace, and to the degree that it increases speed, reduces friction, and allows for a more secure system, I think that's a very, very good thing.
Let's talk about your background. Where were you born?
I was born in Westchester County, outside New York City, White Plains, New York.
And what did your parents do?
My father had a financial printing business, like mutual fund prospectuses and prospectuses in Manhattan, a small financial printing business. He was actually quite smart. He sold it in 2000 to one of the big financial printers that didn't exist after 2010. Right. So I think he made a good trade. My mom was an audiologist at the Burke Rehabilitation Hospital in White Plains.
And were you a star student when you were in elementary or junior high school or high school?
I would not say I was a star student. I would say that I was a distracted student, meaning I had lots of interests, and studying hard was not one of them. Although there was a point. There was a point when I really kind of got it when I was in college, but I I would say I coasted more through high school.
Were you an athlete? Were you an athlete?
I was an athlete, but I was extremely mediocre. Extremely mediocre.
I know the feeling. Okay, so so you went to Hamilton College because you admired Alexander Hamilton, or?
Well, I went to Hamilton College because I didn't get into Williams.
No. Well, but you're the chairman.
But Hamilton College is a great school.
But you're the
I'm really glad. I'm really glad that I went there.
You're the chairman.
And I've devoted the last 25 years to service there, and I do chair the board.
You're chair of the board now.
It's a fantastic institution.
Congratulations. So you graduated from Hamilton. What did you major in?
I majored in political science, and I really thought I was going to go to law school. You
didn't miss anything, trust me.
Well, it was very interesting. All my friends were moving to New York, and if you really think about it, it was 1984, and the financial services world, kind of the bottom of what I would call, was a long drag from the late 60s to 1982. I mean, the moment would be September 15th, 1982, when the 10-year Treasury at 15.9%. We were just starting to come out of that and see equities start to move again, and banks and financial firms were creating analyst programs, and banks were creating training programs, and all my friends were going to New York to do this. I didn't really know much about finance, but it was an opportunity to kind of continue what we were doing in college in an apartment in New York.
So where did
you could earn a salary of $22,000. So I got a job at the Irving Trust Company, which was a commercial bank, in a bank training program. And I went to work on Wall Street, actually literally on Wall Street. Irving Trust headquarters was #1 Wall Street.
But did you interview for a job at Goldman Sachs and get turned down?
I didn't interview. I sent a letter asking for an interview, and I got a reply back saying no, thank you.